And this learning outcome 2 actually focuses on a bit of, understanding on how do we um, get some insight into, accounting. The
Okay.
basic background is that when you look at how businesses operate, at some point in time when the structure of the organization, the business is registered, you go across, register a company with the company's house, you start a business, and at some stage, when you have got the basics in terms of things in place with regards to a place, you've defined the ownership, you've looked at a bit of a structure, and as you have one or two people working within the organization. Then we look at the aspect of, once the company is formed and the business is operational, we look at the aspect of, arranging finances. And
Okay.
in order to understand, finances, we basically need to have an overview and an idea about what are the key things involved in, dealing with money. So when you have a business, and you're looking at basically, um, putting in some money, which is in terms of sources, through savings or, for example, a bank loan, things like that. What you need to have is a good idea in terms of how finances are organized and how, in general, you need to, how in general, basically, you meet the law and legislation around the accounting or, finances in general. So I think here what we are looking at is theoretically today in the learning outcome to understand the principles of accounting which are required for business. What law legislation do we follow? What are the basic minimum requirements of us? When you have a business to maintain the accounts of the company, submission of those accounts of the company, and how you look at the basic terminology in terms of understanding, things like profit and loss, balance sheet, the key financial statements as we call them, and then how do you look at budgeting? How do you look at income and expenditure? So just overall, in a nutshell, trying to understand the terminology of terms which are involved in the accounting and finance side of business is what we're going to study in the learning outcome too. Okay.
Okay. Yeah.
So what I'm going to do is obviously I've got a very simple presentation. This as a topic, some learners do find it slightly technical to understand, but it's a very, very interesting topic if you get the hang of it, because this is something that we can't do without. We handle money on a daily basis. When you go out and buy things, you do a bit of budgeting. When you get your own expenses in order, you look at your own bank account. So this is really the fundamentals that we need to know. And I've tried to kind of make it as simple as possible using this presentation, wherein the idea is to give you an understanding of the key concepts and how to recognize and identify these key concepts from a point of view of their definition. So if somebody is to come up to you and say, okay, can you tell me what are the financial statements which your business produces? So it should be easy enough for you to think about things like profit and loss, balance sheet, cash flow, budgeting statements. And these are four of the main type of statements which a business produces. If somebody comes to you and asks you what is your net profitability, or what is the growth that you're having over the last year, then you should be able to understand that there's something which is being asked about ratios, and you should straight away jump to that when you can understand and then recall some of these terms. So let's look at some of these slides in today's session. Now, when we look at the basics of something called, say, accounting,
Yeah.
can you think of what does the term accounting mean? If you basically look at the term accounting in general, accounts, or you look at accounting as a term, it basically talks about something that you're trying to do a bit of a measurement of, or you're trying to look at trying to measure up something in terms of, when I say accounts and finance, you're looking at transactions. You immediately think of the word transactions, and this is what actually comes to your mind. So this is nothing but a group of items which have common characteristics. That means if you look at accounts and you look at accounting, they will all deal at some stage with values and numbers and figures. And in general, they kind of portray some sort of a situation, or bird's eye view of where the company's financial are or the business's financial structure are. So accounting or accountancy is nothing but a measure. It's a way of measuring the financial information of say a named business or a company or an organization. Now there are different types of accounts. You know that obviously when we look at accounts, when you go and open a bank account, sometimes you look at opening a cash account, you look at a current account, or you look at a savings account. Similarly, in the case of accounting, you have different types of accounts, and these accounts are classified as basically entities which at some stage when you identify them, they will either give you some information related to the related to the items of your business or related to certain figureheads in terms of the business. So when you look at type of accounts, there are accounts like assets, there are accounts like liabilities, you have income and expense. Now these are four various types that we are aware of. Now when we say an asset, that means if you have started a business, say for example you've started a newsagent shop, and you've started that business, you've rented up a place, and in the rented that place, what you've looked at is you bought some stock, things like furniture, a till register. You bought some things which are going to be sold from the shop in terms of inventory. Now, because they are all bought for the purpose of business and are going to be giving you business at the end of the day in terms of services either derived from it or from the sale of those services, would be something which is termed as, asset. Is that okay?
Yeah,
so here, that particular item that you bought, at some stage, if you decide to sell it, or if you decide to, pawn it or sell it in the market, at some stage that value, that item will actually give you some return value. So, for example, you buy a car, that becomes your asset, right?
Yeah.
At some stage, you use it for 3, 4 years, 5 years, and then you decide that, okay, I'm going to change my car, and you sell it. And at that stage, you must have bought a brand new car, say at a value of £10,000, but you sell it after 3, 4 years of usage. It still gives you some return in terms of money. And the reason why it gives you that is because it's an asset. Is that okay?
Yeah, that's
Now,
right.
if I buy that same car on hire purchase or HPA agreement, that means I lease it out, but I don't physically own the car. So as long as I keep paying the monthly installment, I can use the car, I can drive it. But at some stage when the lease comes to an end, either I have to buy that car by giving a balloon payment, or in some cases I can return the car and I take out a new lease. And because you're paying that on a monthly basis, that would be classed as not your car, but classed as something wherein you're using by paying some rental or leasing money against it. Correct?
Yeah.
And that would be a definition of something called liability. That means if you buy that car and you own that car, you paid for it, tomorrow if anything happens to it in terms of say an accident or if it gets stolen, you will be recovering money for it either through insurance or you're responsible for it. But if it's a hire purchase and tomorrow if the car goes faulty, for example, forget the accident another bit, but if it goes faulty, then you just take it to the car dealership, and obviously they will look into it for you, and then you continue to pay the monthly installments because you bought it under lease, saying that okay, the product is going to give me this service, and this is the amount of money that I'm paying for the usage of it. But because you don't physically own the product at any given point in time, that is considered as something called a liability. Okay, so here you're paying an amount every month to get that service from the car dealership. Now, so these are types of accounts that we look at when we talk about businesses. And just to say, for example, list some of these accounts, asset accounts are accounts of value. That means anything which is classified into, when we put that into an asset account or a kind of a, so let's say some sort of a tabular format. If I put things into the asset side, that means that particular item, that particular service, or whatever that thing is in terms of tangible, intangible, but it has some value. That means at some stage, if I have to sell it, if I have to do away with it, then or exchange it or return it, I will still get some value against that, and that's why it's classified as something called an asset. Now, the asset has certain characteristics. When I say characteristics, that could mean that if you buy, say, for example, a car, the value of the car depreciates every year. Correct?
Oh, yeah.
Sometimes when you buy things which are termed as pristine, but at some stage, because they've been used, they've been opened, they become non-pristine. So if you sell, say, for example, a car that you've just bought from the showroom without putting any miles onto it, you might be lucky to, and you might get the same value that you paid in the showroom. But if you've used it for a period of 1 month, 2 months, 3 months, you will see the value of the car depreciates. And that would mean that you might not end up getting, even if the car is still brand new, almost new. You can't say it's new because it's put some miles on it. But at the end of it, you will still get the value for it, but you will get slightly reduced value. And that is one of the characteristics of assets, is that some of these assets that depreciate, or because of the wear and tear and because of the usage, they lose their value over a period of time. Okay.
Yeah.
Then we look at something called liability accounts. Now, liability accounts can be classified as something like an IOU. Say, for example, if you've taken or borrowed some money from your friend and you need to return it, it's still a liability. That means you're still liable to return that money because you've given an IOU slip or you've signed an agreement that, I'm taking this much loan from the bank, and at some stage I will start making the repayments on the basis of, income or whatever. So liability accounts will have entries into it, which will basically mean that they will be claim which others have on you because of certain purchases you have done, or for example, assets that you bought. Now, till you pay for say for example, if you buy a car, but you buy a car on the basis of a loan, a bank loan. Now, what tends to happen is when you take out a loan, you take out a car financing. At some stage, when you sign the agreement, what they will do is they will name the asset or name the value of the car, which is basically the asset or the product that you're buying, and that will be in the name of the bank from which you've taken a loan. But at some stage, if you take on, say, assuming you've taken out a 3-year loan, after you made the payments and the installments and the loan finishes, the bank then transfers the car into your name. But till such time that you haven't paid, the amount, you are liable to, or you're liable to the bank, and the bank in terms, if you do not, for example, make payments or you miss out on certain payments, then they can recover the asset from you because they have given you the money on loan to buy that car. So liability accounts will have, that means you will have claims till such time wherein you have not paid off paid off the value of that car, and once that value has been paid, then in that case, that then would become your, what that would become your asset, isn't it? Will become yours, or essentially you will own it. So liabilities, claims that others have against you or for the products that you bought, it normally is an amount and it has to be paid back before a due date. So for example, when you take out a car loan, you sign an installment plan which will say that 7th of the month or 15th of the month or 10th of the month, you will be paying the installments every month till the loan is being paid off, or for the duration of so many years that you've taken out a loan. So this is basically all put into something called a liability account. Now, there are something called equity accounts. Now, equity account means that there are claims the owner has against the asset. Sometimes what happens is when you open a company, and if you're the owner and the director, what tends to happen is that you will put some personal savings into the business to get it started. Or for example, you might make some investments or loan the money to the business, but loan will be given against a certain asset. That means you would say that the business, because I own it, I'm the sole owner, but at this stage the business needs money for it to, for example, buy a photocopier. Then you might put the money in, but what will happen is, as against that particular money which has been put in, the asset will be basically attributed to you, and then you will loan it back to the company for it to be able to use it. And in some cases, sometimes what tends to happen is, like for example, you would have seen or heard about is that when a lot of people it's a startup company, or when they start a business, what tends to happen is that you don't get a loan, or the finances required, because the business has no credibility. So what in that case happens is that when you go to the bank to seek a loan against the business plan, the bank does a credit check against you, and what they do is they see your standing with regards to the money which is being asked for, for borrowing. Now, in that case, because the business and the company is new, what they do is they do a credit check on you, and on the basis of your financial standing, they give that loan to the business, because ultimately they see that you are directly connected to the business as a director or the owner. And after coming across and doing relevant checks, they feel that, okay, this is the amount that you can borrow, which can be put into the business. So that amount, which is actually loaned by the bank to the owner of the business, is then given to the business. But that loan which is given, there are two people who are liable. One, the company is liable, but because the director of the company is the owner itself, the director of the company is also liable. And in those cases, when such arrangements are put in place wherein you get the money, but you pass it on to the company to be able to use it for operations, are kind of transactions which come into something called equity amount. And sometimes what happens is you will see that the director would say, okay, I wouldn't probably withdraw this money, but what I would do is basically take so many shares of the company. So when you open a company, normally people open the company with one share. But in some cases, if you are putting in some investment, what you do is you say, okay, I own the 100% shares, but what they will do is they will net value the share, they put a value to the shares, and they will say, okay, because I've loaned 10,000, so if I have one share is worth 10,000. So they equate it to some sort of a net worth or a value, so that at some stage, if the company is to be sold, or the director has to realize the money, then in those cases, what they can do is they can actually recover the value through the value of the share by selling it to a new owner. Is this something which is understood?
The equity account.
Yeah.
That's just I'm not exactly understanding that bit.
Okay, there are different types of accounts. So what we look at is, when we talk about something called equity accounts are accounts wherein you will see that the company will basically have some sort of an equity. That means it is shares, or it is something to do with, for example, bonds. That would mean that if in some cases the company has to borrow money, say externally, it could be borrowing money from the owner director or borrowing money from the bank, then in that case, what tends to happen is that the company will need to issue some sort of a instrument, which could be a share or it could be a bond. And that would mean that this particular instrument will then equate to some sort of a value with the assets of the company. Right?
Yeah,
right? So, for example, here we say, if I am a sole proprietor or a business which is a sole trader, and because I own all the stock of my business, if I have to value the business or borrow money against that business, what I would have to do is I would have to issue a share, which at some stage would say that, okay, if I have to recover the money, then I have some stake into the business. And that stake can be only given across through something called a paper or an instrument, like a shareholder, somebody who becomes a shareholder, or in some cases, somebody in large organizations, you would see that they normally what they do is they split the shares or release bonds, which are 2-year, 3-year bonds, and they give some interest on it because they're borrowing money from the capital markets or borrowing money from the stock market. Is that okay?
Yeah, that's okay. No. Yeah.
Now, there are other types of accounts which are called income and expense accounts. Income and expense accounts are basically accounts which are kept by companies to keep track of expenses. That means if you have an income coming in, that means you've issued an invoice, and against that invoice, if you get some money in, that means there is an income coming in. If you sell a product and you have some money coming into the business, that's an income account. But when you say, for example, incur an expense to basically produce that good or service or deliver that good or service, then you have something called an expense account. Now, sometimes when you look at a profit and loss account, It is also termed as an income and expense account because what it keeps track of is something called the money coming in and your money going out. So from that aspect, these are accounts which basically help you keep track of accounting entries. That would mean that you clearly know what is coming in and what is coming out. And these are accounts which an accountant actually maintains on a weekly, monthly, quarterly, yearly basis to keep track of transactions happening in the business. And these transactions are then labeled as, transactions which are either contributing towards money or, contributing in terms of money coming into the organization, or in some cases, you're paying for the goods and services, and that is money going out of your company's bank account. Now, there is something which called, we need to understand something called basic principle of accounting actually hinges on a fact which is called an entry system. Now, in some cases, what we do is we do a single entry, and in some cases, we do a double entry. Now, single entry means that you basically only account for each transaction. That means whether it's an invoice that you have generated or whether it's a expense that you paid out. But in the case of double entry, what it tends to do is when you look at other financial statements, which we will look at in a bit more detail in the subsequent slides, what typically tends to happen is when you create financial instruments like profit and loss account, balance sheet, and cash flow statements, what you will see is there are always two entries which happen. That means if you're, kind of having money coming in, that would mean that there is a credit happening in your account. But because you would have sold something at the other end, in terms of that money coming in, that would also create a debit in your kind of a debit entry also in your account. So imagine a situation that you are, say, for example, a retailer, and you have a stock of few items that you sell from the shop. So somebody comes into your showroom and they buy a washing machine. So because when they buy a washing machine, what tends to happen is you are selling a product or a particular item, and against which you are actually realizing the money coming in. But at some stage in the back, if you look at, you would have bought that inventory or that stock from another firm for which you would have received, for which you would have actually given out a purchase order, and against that purchase order, the supplier would have provided this product to you. So for this kind of transactions, when we look at, there is always a debit and there is always a credit. That means you're receiving something because you must have placed an order, or if you're receiving money, then that means you would have delivered a service because of which you're receiving the money. And this kind of a system wherein you record both the entries is called the double entry accounting system. And in some cases, you always look at, for example, the government, they also look at a single entry and a double entry accounting system. Sometimes what they do is the government always gives out money, but in some cases, the government also receives money against the services they provide. So for example, HMRC, the revenue, might be seen as, sometimes returning checks to people because they've overpaid and they've earned some tax credit. But in some cases, what they do is when they receive money, they have to create an entry against that particular account or that particular person who has actually remitted the money. So this kind of a system which we look at in accounting that we follow is something called a double entry system. Is that clear enough?
Yeah, that's clear.
Now, when we look at some bits in terms of things like what do you call? Let's look at, say, for example, accounting in particular. We always look at the two sides of the coin. So because you have assets, you have liabilities, you have income, and you have expenses. So that is the reason we follow this double entry accounting system. So that the left-hand side of the balance sheet, which is your liabilities, your assets, should be equal to the right-hand side of the balance sheet, and the balances at the end of it need to match. So if I say that, I've done a turnover of this much in the business, that would mean that at some stage you would have also delivered services on the basis of which you made this turnover. So that is why we follow something called the double entry system. And this is something which is very basic to understanding accounting and finance when we look at, any business transaction. Now, The other term which we come to is transactions. What are transactions? Transactions are when we look at entries, essentially. That means every single thing or activity that you do actually is termed as transaction in accounting. So if you, for example, raise an invoice, that means it's a transaction. Now, what kind of a transaction is it? Invoice is supposed to give you, if you're raising an invoice, it could be a purchase invoice, it could be a supplier's invoice. So you have to kind of actually understand very clearly that what side of, what kind of entry would this create and which side of balance sheet this entry would go into. Now, sometimes if you're looking at raising an invoice, which is an invoice for buying, say, a set of, hardware. For example, you're expanding the office and you're buying 5 new PCs. So when you release this invoice to a supplier to supply 5 new PCs, or say, for example, Macs, basically what you're doing is you're raising a purchase invoice, and once that delivery comes in and it's installed, these PCs are installed in the office, they become a part of your asset or liability?
Is it liability?
Well, yeah, it's a good point there. It could be both asset and liability. The reason it could be liability, could you think of why you would term this as liability?
Because
Simple enough, because it might not have been paid for. The supplier must have given maybe a 30-day or a 60-day credit, for you to be able to make the payment. And unless the supplier actually realizes the payment, that might still be classified as liability. But the moment, assuming in this situation, the moment you paid for that invoice, then those PCs become a part of the company's
asset.
asset. Yes, that's correct. So when you look at these kind of entries which come in and which happen, you release a purchase invoice, that is nothing but a transaction. But it would depend on whether it's an asset or a liability, or whether it's a supplier's invoice or a purchase invoice, whether it could go into the the income or the expenses side, will actually be classified as something called transaction. So you do a lot of transaction in accounting, money coming in, money going out, you issuing an invoice. It could be a credit note. That means you bought something, you paid for it, but you canceled the order, so the supplier has given you a credit note. So these are all transactions which typically happen within the accounting remit. Sometimes the company or the business might have 2 or 3 accounts, right? So if they have 1 or 2 bank accounts, sometimes you will transfer money between the accounts, because one company might be lending services to another company, but because that would mean that the physical transfer of money has to happen, sometimes you will transfer money between accounts as well. And that will also amount to something called transactions.
Yeah.
Okay. And here an example that I would give is when you transfer money between accounts is when you look at, say, solicitor firms, you look at accounting firms, you look at mortgage advisors, they receive a lot of money when they do transactions for their customers. But that does not necessarily mean that it is their income, right? Sometimes, if for example, if you've gone to a mortgage advisor and the mortgage advisor has, got your mortgage approved, now the initial amount has to be paid. So you pay the initial deposit to the mortgage advisor, and that goes into the client side of the account which the mortgage advisor owns. And that money, when he transfers it to the bank from his side, then basically is a transaction, and that is a transfer happening on your behalf because he's paying your deposit to the bank or the building society, isn't it? So sometimes when you buy a house, your mortgage advisor works in tandem with your solicitor when they get the lease and everything approved, and the papers are exchanged, the contract is exchanged. You have to transfer the money to the solicitor's account, and the solicitor then holds the money in something called a client account. And from that account, they transfer money to the bank to be able to pay for the initial deposit for the house.
Yeah.
And whatever that money, we don't know, but has a combination of some money which is a commission and some money which is going directly towards the the payment of the deposit. So the money which remains in the client account after paying to the bank the deposit for the mortgage actually is nothing but the commission which the solicitor actually gets from the bank, right?
Oh,
So when you look at this kind of transaction, what is happening is you're also seeing transactions, because these are individual entries which are happening in the accounting system, and each of this entry is amounting to something called a transaction. And this also involves sometimes money exchanging hands, but also exchanging hands within a single business, and it involves sometimes transfer of money between accounts. Okay.
oh, yeah, yeah.
Like you have a savings account and you have a current account. You get your wages in your current account, but at the end of the month, if you have some money saved, what you do is you set up a direct debit which goes from your current account to your saving accounts, isn't it?
Yeah,
So you see transactions happening within your own account as well, which is things like, gas and electricity, council tax, a couple of other things going. But at the end of the month, there might be one transaction which will happen within your own bank account, wherein that money would go from your current to your savings account. Okay.
yeah.
Now, how do we record these transactions? We basically record these transactions as something called entries. Okay. How do you know that this money is coming in or money going out? Unless you record the transaction in either a credit or a debit, isn't it?
Yeah.
So sometimes you will see that you're expecting a payment to come through, and when you expect that payment to come through, you will look at which side of the account, money in or money out.
Money in.
Money in.
Oh no. Yeah.
Money in. If you're expecting a payment to hit your account, that means you are expecting money to come into your account, which is, say, for example, your wages. And in those cases, you will look at a debit entry or a credit entry.
Yeah.
You look at a credit entry, isn't it? The money is coming into your account. So it is
Yeah.
credit to your account, isn't it?
Yeah, definitely.
So when we look at these kind of transactions, we look at something called entries, and entries define whether the money is coming in or money is going out. Okay.
Yeah.
Now, transactions have to be recorded. Why do you think transactions have to be recorded?
Just in case money goes missing.
That is correct. So just in case money goes missing, sometimes you have to, not sometimes you have to record transactions, because they also help you do reconciliation. That means if money goes missing, or if, say, for example, you haven't kept a record of it, then there is an electronic record which is kept by the bank, because at some point in time when they reconcile the accounts, the transactions are the only proof that the money has actually come in or has gone out. And
Oh.
what type of transactions, or what type of transactions could be used to record this entry? What are the types of transactions you do at the bank?
Types of.
So what are the financial instruments that you deal with in terms of money? What transactions you do at the bank? You write sometimes a check, isn't it? You use a checkbook to write out checks, right?
Oh, checkbook. Yeah.
Yeah. You also use your debit card.
Yeah, debit card and checkbook.
In some cases, the bank also gives you a credit card.
Oh, credit card as well.
Yeah. And then in some cases, sometimes you go up to the bank to withdraw cash.
Withdraw. Yeah. Oh,
Yeah.
yeah.
So basically, when you look at recording transactions happen in various forms. They can happen through a check. They can happen through a bank transfer. You might do an electronic bank transfer by online banking, but then also the transactions are recorded. You might do a transaction with your debit card in a shop, buy something and you pay for it through the debit card. In some cases, you go and withdraw cash and then pay cash for that, from the ATM, and then you pay cash for that, item that you're buying. But each transaction is basically represented by an entry, and in some cases, these entries could be done through various instruments like a credit card, a debit card, a check, or even cash in some cases, isn't it? Yeah. So recording of transactions is a must, because they help you do the reconciliation, and also they are the only way to actually record these entries, is because if they do not record entries, then the money can get lost, right? You can keep loss. You cannot keep track of the transactions unless you record an entry. or record those transactions.
Yeah,
Okay.
definitely.
Now, towards the end of the year, what do? We come out with, sometimes you go to the bank and you say, okay, can I get a monthly bank statement? Can I get my 6 monthly bank statement? Can you give me a statement from this date to this date? The reason why you want that statement is because you want to keep track of the transactions which have been done over a point in time, isn't it?
Oh yeah, yeah,
Sometimes
definitely.
what happens is you receive your wages and oh, yeah, I've received my wages, great. But you look at the 10th of the month and you look at your bank account and say, where have they disappeared? I only received my wages last week. Where have they gone? So
Yeah,
what you do is you dip into your bank statement to be able to calculate and see where has actually the money gone. You know, so you would see various entries like, okay, the council tax is gone, the rent is gone, the mortgage is gone, or whatever, and you've spent money on diesel or petrol, and you've had food outside, and that money is gone, and that gives you a clear record of how your money has gone out of the bank, and that is nothing but something called keeping track of your transactions, right?
yeah, yeah. Keeping track
Now,
of
this is for personal basis. How do you think businesses record this, across the year?
through their technology.
Yes, through the technology, but why do you think businesses need to record this?
So just in case the person that's lost their money, they've actually used it, they need to have proof.
Right. In the case of businesses, yeah, you're correct, but look at it from a macro perspective. In the case of businesses, what tends to happen is the businesses need to publish some sort of statements at the end of the year. Now,
Oh
if they
yeah,
haven't recorded these transactions, then how would they know how much money has been made, or what have been the expenses, what is the profit, or what is the balance in the bank? So in those cases, when you look at from a business perspective, businesses are under obligation to do yearly accounting. That means they have to submit their yearly accounts to Companies House. Now, if the transactions are not being recorded, then there is no way that they will be able to produce the statement of records, a statement of some sort of a statement towards the end of the year for record purposes to submit to Companies House. So here, the businesses would record each and everything in terms of money spent from the debit card, bank withdrawals, inter-transfer happening through the bank, payment of invoices, and at some stage, even petty cash, which is used in the office to buy, small items, has to be recorded against individual invoices, so that there is a clear track record of if the accounts started off with, say, £100,000, towards the end of the year, there should be invoices or expenses which total up to £100,000, which the business has spent. So if the recording of transactions has not been done, there is no way that they can tally that, okay, we had a bank balance of £100,000, but at the end of the year, we have a bank balance, say, zero. That would mean that, we need to have a record of transactions of how that £100,000 money has been spent, isn't it?
yeah, yeah, definitely.
Okay. Now, when we look at from a business perspective, what we do is we also look at valuation. Valuation means that if you have a certain asset, that asset has a certain value, right? That means if you buy something and that is something which is item which is worth some value, that valuation is that value of that particular item is called, we use a term called valuation. So when you look at, say, let's look at the personal example first. What phone do you own?
It's a Sony Xperia.
Okay, so you have a Sony phone, right? Now, when you bought this phone, you got this under contract. This value of the phone would have been, say, 300, £400,
Yeah,
right? But you've used it for how many years now?
about 6 months,
So
only a
you've
year.
used it for 6 months. Now, the value of this phone, because you've used it for 6 months and it's no longer brand new, you paid £300 for it, for example. The value of the phone today might be worth £100.
Yeah, that's true.
So basically, what we are trying to do is, at some stage, because we bought this and we've paid money to buy this particular phone, what we are after is to find out what is the value of this particular product at this point in time. So when you try and ascertain the value of a product or a value of a service, at any given point in time, that process is called valuation.
Ah,
Okay?
oh,
So, for example, you bought a car, and you bought something, for example, which is what you like, but you're now looking at selling it. So, what you before you decide you want to sell it, what you do is you go and get the car. What do you go and get the car?
oh, you go get the car fixed.
The car fixed, or you go and get the car valued, right? Before you sell it, what you want to do is, okay, I bought it for so much, so much money, but what is its current value? What is its value now? What you do is you go to for example, you might go to Auto Trader, type in your registration number, and it will text you an estimated value of the car. You might take it to a car dealership and you say, okay, I want to sell it because I'm in urgent need of money or whatever it is. And what they will do is they will value your car, isn't it?
Yeah.
Sometimes when you value the assets or value the products and services which the company has, they also have to be recorded. So imagine a company which is basically into production, right? When you look at large companies which have a lot of these factories and they have a lot of these factory machinery in it, which is used for production. At some state, what they do is they value if you have to get the business valued, what they will look at is they'll look at all the fixed assets and all the money in the bank. And what they will then do is come at a value and arrive at something called a valuation, saying that, okay, your business is worth this much if you have to sell it today. And the valuation has been done on the basis of what are the assets. That means the things like plant and machinery, assets in terms of things which you have in the office or in the the plant and apart from plant and machinery in the office, you have things like the infrastructure. For example, if the land is bought, the plot is owned, or some of the other things which the business owns are all put together. And then what you do is do something, and you also look at the money in the bank, the liquid money. That means that is money immediately available, and you combine it together and you put some sort of a valuation on it. And that is something which is called valuation of the business, right? There is something which you must, I don't know whether you've come across or not. Sometimes if you're going to buy something in the market, say for example, you're going to buy a business, what you do get to see is on the balance sheet, sometimes they also say goodwill of the business and they put a value next to it. Now, this is a particular thing which is intangible. That means goodwill you cannot touch, you cannot verify, but there is a goodwill of the business and there is a certain value attributed to it. Have you seen that or heard that?
I haven't heard of that, sir.
Right, okay. Basically, when you have a company which is running for a number of years and it has some reputation and has some, standing in the market because of the market share that it has, for example, or in terms of the products and services it owns and sells, they might have also over a point in time created a brand and also a reputation attributed to that brand. And that is called nothing but the goodwill of the business. So sometimes when you buy and sell businesses, you will get to hear that, for example, if somebody is buying an accounting firm or is buying say a security business or a firm, in general, what they look at is they also look at the reputation and the goodwill of that business. That means how long has the business been going? Are there any CCJs or county court judgments or any sort of claims made against that business? And what is in general the standing of the business in the market as against its competitors? And this is sometimes classed as something called a term which is something called goodwill. Okay, and in because the business has been going say for 20 years and has had no negative impact in terms of its reputation or any cases or any court cases, that is classed as something called goodwill. And in those cases, the goodwill of the business is also attributed in terms of some sort of a cost on the balance sheet. That means if you have to buy my business, what I'm looking at is you will have to pay for the goodwill of the business as well. That means if you start a new company today and then you put all those investment and other bits and pieces in, at some point in time, this business will be valued at the basics of what is the net assets and the net receivables. That's it. But over a point in time, the business has been running for a good number of years. The business also acquires something called goodwill or builds a reputation, and that has to be paid to the business owner when somebody is looking at buying that business. So it is in addition to something which is called the income or expenses or liabilities, but this is mostly something called the intangible value, which is in terms of the the reputation of the business in the market. Is that okay?
Yeah, that's fine.
Now let's look at some of the reports, which accounting as a department produces. Now, some of the reports which are required to be published by the business in particular. If you are a limited business or if you are a limited liability business, public sector, private sector, organization, sole trader, every year the company house regulates that you have to publish your accounts, and these accounts have to be published in the form of these financial statements. Most businesses would produce something called an end result, which is called a balance sheet. Okay.
Yeah.
But during the course of the year, what they will also do is they will maintain other statements which will help them compile a balance sheet towards the end of the year. Because a balance sheet is something which is produced towards the end of the year, which is a summary of all the financial transactions of the business. It's an end statement. Okay. A balance sheet is always going to be time bound. That means it is produced for the last financial year, for this financial year. It'll have a start date and an end time in which the summary of all the financial transactions of the business are going to be summarized. And that statement is called, or that particular information sheet is called a balance sheet. Okay. Now, income statement is something, so we look at these statements in a bit more detail, but just definition wise, so you're looking at a balance sheet, income statement, there is something called a profit and loss account. And in some cases, you look at statement of cash flows and statement of owner equity. Now, let's look at them individually. Now, what does balance sheet represent? It represents a situation in terms of financial position of a company at any given point in time. So when I say that the balance sheet is being produced for as of the last financial year, and last financial year in most cases for most companies is, say 31st of March. So when they produce that statement as of 31st of March, it shows the financial position of the company in terms of asset, liabilities, income, expenses, whatever it is, as of that date, or that point in time. Okay.
Yes.
This particular statement, when produced, definitely needs to have a date or a range of, in terms of a date range. So it is produced for this period from this date to this date. And this statement actually presents assets and liabilities, of the business or of that company at any given point in time. Okay.
Yes.
Now, balance sheet normally has, assets and liabilities, but sometimes you classify these assets as something called current assets and also classify them as something called non-current asset. Now, current assets are, what are current assets? Current assets are cash or other assets that will be converted into cash during an operating cycle. That means if the company wants to realize immediate money, then they can actually sell some of the items or, the inventory or the stock that they have, and also utilize the bank money in the bank. And that is why it is called current assets. That means it can be sold immediately to realize capital or money.
Yes.
Okay. Non-current assets are which require a bit of time for them to be converted into cash. Now, if you imagine a situation wherein if you have to, if a business has to immediately raise money, then they cannot sell their plant and machinery. They have to put on an advert, find a buyer, and that would take a bit of time before they eventually reach a sale.
Yeah.
So those assets, which is like plants and machinery, are definitely, instruments which they can sell and realize money, but they cannot be sold immediately to a buyer and cannot realize cash tomorrow or in a short period of time. And that is why they are classified as something called non-current assets, isn't it?
Yeah.
Now, governments, for example, if they have to print money, in what form do they store their current asset? So, for example, gold, what normally every country does is, if we print, the Bank of England, for example, has to, print new notes or currency, then what they also have to have is, at some stage, if this currency has to be withdrawn or taken back by the Bank of England, they will have to in return give what back to the customers or different banks across the world. They won't want to use pound. they'll have to give them back what?
The money
Amount, yes, but how will they repay that amount?
with the new currency.
Agreed, with the new currency, or in lieu, they will have to give them gold, isn't it?
Gold. Yeah.
Yeah. So when you look at the Bank of England, Bank of England basically has the number of, the amount of currency which is in circulation. They almost have that much amount of gold in the Bank of England, because that kind of offsets, the requirement of printing currency. Because if the currency is to fall, decline, has to be taken back tomorrow, then in lieu, the bearer of this note can go to the Bank of England and ask for this in exchange to be returned for gold, isn't it? So there, the current asset which the government has is gold, right?
Gold.
And non-current asset could be, for example, things which they have to take the currency back, and over a point in time they will say, okay, we'll issue some bonds and other things and pay interest, but over a point in time they will have to, return eventually this money back.
Yeah.
In the case of businesses, they classify assets which can immediately give you money. Stock, inventory, cash at bank is called something which is classified as something called current asset. But in some cases, the money which cannot be realized immediately by the sale of assets is then classified as something called non-current asset. Similarly, you have liabilities and you have non-current liabilities. Now, current liabilities are debts which will become due within a year, and they are reflected on the balance sheet. And non-current liabilities are these debts are for more than a year. That means they might only a portion of them will appear across every year's balance sheet. So a current liability would be if wages which have to be paid to these employees every month are classified as something called current liabilities, because you wouldn't expect your wage to be paid in 2 months' time or in 3 months' time. If you work there for a month, you expect your wage to be paid every month, isn't it?
Yeah.
So that is something which is a current liability. Imagine if if the company has bought, say, a fleet of cars to be used in sales, and each of the sales manager has been given a car, but the car has been bought on hire purchase or some sort of a leasing program from the car dealership. So what happens is the car is essentially a liability because it's been used by the business to generate business, but because the value of the car is not being paid and it's taken up on some sort of a hire purchase agreement for 3 years or 5 years, does not mean that it is a current liability in the first year of the purchase, isn't it? So they do not have to reflect the value of the full value of the car in the balance sheet in the first year. Because the hire purchase is for 3 years, you divide the value of that asset across 3 years to reflect into something called the liability in the balance sheet. Yeah. So those will be classified as something called non-current liabilities. So because the car is, say, worth 30,000, but you have a 3-year loan, so that means each year the liability is about how much?
More than.
So if you bought a car for 30,000, but it is bought across for a period of 3 years, what is the liability every year for that car that you would put into the balance sheet?
It'll be more.
No. Let me repeat the question.
All right. Yeah.
Company decides to buy cars for its sales personnel to generate business, right? Each
Yeah.
car is worth 30,000, but the cars have been bought on a hire purchase for 3 years, and the value of the car is 30,000. So what is the liability that you will put in the first year?
The.
If you buying something across 3 years,
Yeah.
right? So if
Yeah.
the car is worth 30,000 and you're paying it across 3 years, what is the liability every year?
10,000.
10,000, that's correct. So what the companies would do is basically in the balance sheet, they will put this across for 3 years.
3 years.
Correct? Now, what is a balance sheet? Balance sheet basically consists of things like, it is a list of things which include assets and liabilities, but they also have something called long-term asset and long-term liability. So long-term asset could be, for example, the company's purchased, a piece of equipment or machinery, which is going to be used for a period of 10 years. But that purchase has been done keeping in mind the business it generates by the usage of that machinery for the next 10 years. So what they do is they tend to put that in the asset, but because it is something which will help them make money for the next few years, it is classified or termed as something called long-term asset. Similarly, a car bought across for a period of 3 years is a liability, but it cannot be written off in the first year because the purchase loan runs across 3 years. So it is something which is termed as long-term liability, right? Okay. Now, balance sheets, as you've told, are a statement of the company at a given point in time. That means they reflect the company's financial situation or financial position at any given point in time. Okay. Let's look at the second statement. What is an income statement? As the name specifies, income statement is nothing but a summary of income and expenses. That means money coming in, money going out. As a managing director or as a director of the company, you might tell your accountant saying that, can you get me an income statement for this month? Or can you give me an income summary or a statement summary for this week? So what the accountant will do is basically print out something or, tabulate all the invoices which have been coming in and against the purchase orders and give you something which is a financial standing for that week or that month or for that, quarter, isn't it?
Yeah.
So if you ask for a report, what they will do is they'll generate a report from the system, which will basically be a summary of all the money coming in and all the money going out because of expenses. And that would be nothing but a income statement.
Yep.
Is that okay? Now,
Yep.
sometimes you will see that there is a bit of a transition period which tends to happen when you go between financial years, right? So what will happen is if you are in a financial year, that means which starts on the 5th of April and finishes on the 4th of April, you will basically see that you will generate a balance sheet at the end of this period. But in order to keep track of these transactions which are happening on a daily, weekly, monthly basis, you generate something which is called an income statement. And this income statement actually allows you to look at the activities of transactions, basically activities of transaction for a particular period of time. So the key difference that I want you to understand here is a balance sheet is a financial statement as of that date. Okay.
Yeah.
But an income statement allows you to look at the financial position of a business over a period of time. So it allows you to look at a date range, right? And in the case of balance sheet, it is as of that date. So when I say as of 10th of October, this is the balance sheet of the company. That means it reflects the financial position of the company as of 10th October. If I go into 15th of October, then I'll have to regenerate a balance sheet, which will give me a statement or a position of the company's business as of that date. But when I look at an income statement, an example here would be that I give you is when you look at, say, for example, a financial position of a company, what they look at is they ask you to generate something called an income statement. Can I see a statement of your incomings into the account? And basis which the bank would then set some sort of an overdraft limit. So in your personal case, let's look at a personal situation of finances. Now, sometimes what happens is when you open a new bank account, you don't get any overdraft facility because you've not had many, transactions which have been done primarily from a point of view of, number of transactions that you would have ideally done, in the account. But over a point in time, the bank is able to then see that you're doing regular transactions. There's money coming in, there's money going out, and they always see a certain amount of credit happening or a balance remaining at the end of the month in your account. So at some stage when you go and apply for an overdraft, what they look at is that, okay, you receive a steady income into your account and there are some outflows which happen, but your net inflow is higher than the outflow. That means your incomes is more than your expenses. So what they then do is they do a bit of risk hedging and they look at what they do is before they look at giving you a bit of an overdraft, they look at an activity of your account over a point in time, say 1 month, 3 months, 6 months, and then they decide to take this decision of giving you a overdraft. Correct?
Yes.
So why do they look at over a period of time? Because what they want to do is they want to negate out all the variances to see whether in some months you could be overdraw, for example, having less money coming in, but in some months you are having more money coming in, but your expenses are also more. what they want to do is they want to even out that kind of variance in your account before they take.
Yes.
And how can they look at this over a period of time? Can they look at a balance sheet?
Yeah.
Well,
No,
a
not.
balance sheet, no, not a balance sheet. They will not be able to look at a balance sheet because a balance sheet is like your annual account summary, which you get towards the end of the year.
Yeah.
What they would want to look at is they would want to look at this statement of your bank, of your bank account over a period of time, which is something very similar to something called the income statement, because they want to see income coming in or money coming in for a number of months, weeks and months before they decide on this overdraft.
Yes.
Okay. So for a business, that is called the income statement, and that income statement refers or represents the activity of the business in terms of expenses and income over a period of time. Is that okay?
Definitely.
Now, this is how a balance sheet typically looks like. A balance sheet is a combination of something called assets, which is on the left hand side. That means this is things or let's put it this way, articles or things which the company owns and which are a part of the company in terms of tangible material which they've bought over a period of time. And on the right hand side, you have liabilities, which is nothing but the money the business owes or the expenses which have yet to be paid to the suppliers or customers, whatever it is. And in addition, you also add something called equity. That means if there is additional income or a money which has been put in by the owner, equity which is put by the bank or shareholders which have shares, those will also be classed under the liabilities, is because at some stage you will have to pay dividends, or you'll have to return this money, or you'll have to return, pay money to get this into your assets.
Yes.
Right? So this is how a balance sheet looks like, and the left side of the balance sheet is assets, the right side of the balance sheet is normally liabilities, and basically the left side is always equal to the right side because of the which entry system we follow?
The balance sheet.
No, the balance sheet always the left side is equal to the right hand side, because what kind of a entry system we follow here in the UK?
Entry system.
Yeah, single entry or double entry?
Oh, single entry.
Double entry system,
Oh,
not single entry. Double entry, because double entry is because you look at creating an entry for money coming in, because that money would have come in because you would have sold a service or a product. So you make an entry on the corresponding side to basically look at delivery also. So there's an income and there's an expense, there's a debit and there's a credit. Okay?
Yes.
And so balance sheet is constructed on the basis of something called a double entry system. Okay?
Yeah.
Now, what does income statement give? Balance sheet, as you know, comprises of something called liabilities and assets, right? Assets could be of how many types?
Assets could be of three.
Okay, what are the three types?
The three types.
So assets could be of two types, not three types, two types, current assets and non-current assets. Similarly, liabilities could be of two types, current liabilities and non-current liabilities. Now, in the case of income statement, what do we look at when we look at the income statement? So where we are looking at something called, income, which is nothing but income or cash coming in, and expenses or money going out.
Money going.
Right? So income statement will basically, what will it help us to do? Income statement will help us keep track of money coming in and money going out. And at the end of it, if we do a net of money coming in and money going out, what will that give us?
Profit.
Profit. That's exactly spot on, profit. So if you have £100 and you've gone out and spent a bit of money on, say, you've had a bit of a meal outside, you bought something for yourself from the shop. Towards the end of the day, when you calculate, what you tabulate is, you look at, okay, I've spent £20 in the in the store to buy a jumper for me or myself, and then I've spent £35 for dinner, and then I've paid £10 for the taxi. okay, I started off with £100, but I've spent £65. I'm left with 35, and that means I still have £35 as credit in my pocket, isn't it? So the idea of you doing this calculation towards the end of the day is to understand how much did you start with and what you've ended with, and that then lets you know that okay, this is the money that I've been able to save. Though I budgeted that I might go out and party and might spend £100, but I ended up spending only 65. So I have still £35 left, which I could save as put it across as savings. So similarly, in the case of income statement, what basically you look at is you look at the income, which is nothing but money coming in, and expenses, or which is basically invoices or products and services that you are availing for which you have to spend money, and that is nothing but expenses. So imagine a situation wherein you work within the office, and in that office there is you have tea, coffee, photocopy, paper, you use paper for photocopier and things like that, and then those are nothing but you pay a rent, you pay rent and gas and electricity, and there are some other expenses that you do in terms of stationery and all those bits. That is nothing but all classified as what? Income or expenses?
Income.
How is it income, Qasim? So if you are working in an office and you buy paper, you spend money on some tea, coffee, you pay your rent, pay for electricity, that is all income or expense?
Expense.
Expense. Income would be money which is coming in through offering your services, or selling the business. If the business is, for example, say for example, what kind of business? Say for example, let's look at a call center business. So if you're offering services, you've signed a new contract and you've acquired a new client, and the call center is then the agents in the call center are then providing a particular service against which they're getting paid. And that would mean that if you've won a contract, that is money coming into the business, and that is classified as something called
profit.
Profit. Yes, you'll make a profit by minusing your expenses, but that is basically money coming into the bank, and that is classified as something called income.
Income.
Yeah. Now, sometimes you will see that you will not just have income in the form of cash coming in, but you could also have income which is coming in the form of something called tangible, say for example, tangible things. And that would be, say for example, sometimes what happens is, if I give example of a retailer here, we look at, and that would mean that you look at Amazon, for example. And when we look at Amazon, for example, here what we are looking at is that you buy something, but you change your mind and the product has got delivered to you, but you send it back to the warehouse, right?
Yes.
Or you return it back to Amazon. Sometimes when you return it back to Amazon, what happens is you paid for it, your credit card has been debited, but because you've returned the product back to Amazon, what that would mean is they will recredit back the money which has been charged to your, debit or credit card. Have you seen that happening, or have you experienced that in the past? If you bought something from eBay, Amazon, online, sometimes you end up changing your mind, you return the product and the money gets debited to your account. But then when you return that product, it also gets credited back to your card or your bank account.
It's not happened to me, it's happened to my father actually.
Yeah. So why do you think that happens? Is because at every stage, the transaction is recorded, and sometimes when you receive a product or you buy something and you're not happy with it, you return it back. You return back something which is the inventory or the product that you bought, and because that goes back into the supplier stock or the seller stock, at some stage they have to release the money back against which you had actually paid. So this then nullifies the transaction, and in those cases, this is also something which is tracked through the income statement. Is that okay?
Yeah, that's fine.
Okay. Because it's goods and receivables. That means sometimes you buy goods and you pay for it, but sometimes you return the goods and you receive your money back against it. Okay?
Okay.
Now, the third type of statement that we look at is something called statement of cash flows. You have a statement of cash, which is basically money which is in the bank, And this statement of cash is something which accounts departments, various departments like sales, marketing, HR, they produce, and they produce it because what they have to do is they have to document and budget for the expenses they are planning to do across the year. So sometimes what you will see is if you work within a business, your boss will come to you or your line manager will come to you and say, okay, we've got a budget allocated of £10,000 to do some promotions. Can you make a plan in terms of what kind of promotions you want to do and what is the estimated cost of those promotions? Right?
Right. Right.
Now, when that is the mode of discussion, what that means straight away is that at some stage, what you're going to do is you're going to create a list of activities and appropriate some budget next to those activities that you're going to do. And that basically creation of those activities and budgeting some amount next to it will help you produce something called a budget. Say, for example, a marketing budget. Say, for example, something like a promotional budget for October. Like Halloween is coming. Let's take up an example of Halloween, right?
Yeah.
Now, across all the stores in Asda's and Tesco's, you will see a lot of Halloween promotion which is happening. So from the head office, they must have given some instructions then that, okay, each store can actually produce some sort of a promotional, we will do some promotions from the head office, but the stores will also be able to do some local promotions in and around the date of Halloween. And this is to help generate more sales. So sometimes what will happen is the general manager in the store will ask the supervisor and the assistant manager is to prepare some sort of a budget, that what do you want to do for the promotion of Halloween, for example, and to increase more sales. So that would mean that in those cases, they would basically create some sort of a list of activities and they would appropriate some sort of a budget next to it, saying that, okay, if I do a promotion wherein we do, we invite some characters outside the store to kind of, do an activity that would cost us £1,000. If we do this across 3 months, 3 weeks, it will cost me £3,000 because we have to contact the agency. They will bring in a few people and we have to pay for those services. Now, those kind of things that you basically create to kind of, get an approval for would be casted, or termed as something called a budget, right?
Yeah.
So what you're trying to do is you're trying to prepare a statement which will give some estimated idea of the costs which will be required to do that activity. Correct? Yeah. And in those cases, when you look at creating some estimated, statements, which will be giving some idea in terms of an estimate for the activities which are supposed to be done and against which the expenses will be incurred, would be used to create something called, or would be termed as something called cash flow statements. Is that okay?
Yeah.
Okay. So can you think of some sort of a cash flow statement which you have seen or has been produced or you are aware of?
Cash flow. Um,
So if you look at, say, for example, when we think of finance and accounts, just think of your bank statement, right? Now, sometimes you get to, most people look at their bank accounts, towards the beginning of the month, end of the month. Some of us also look at our accounts, almost on a daily basis. There's nothing wrong with it, but the reason why you want to look at your bank statement is because you want to see how the flow of money is happening in your account.
yeah.
How much is coming in, how much is going out, what is the frequency. You want to look at all these changes. Now, this can only be done if you then look at, say, for example, the bank statement, maybe on a daily basis or, on every 2 or 3 days. And then you compare that, okay, where the money has come, where the money has gone, and what are the debits which are happening into the account.
Oh, yeah.
So basically a cash flow statement, in other words, would be looking at showing you the changes in the balance, in the cash balance, or, in some sort of a balance in your account. And in order to track those changes, what you normally tend to do is you create something called a cash flow statement, right?
Yeah.
Now, in most businesses, what tends to happen is they receive a lot of money coming into the account towards the end of the month because of sales happening. But over a point in time, what tends to happen during the course of the month, there is a lot of money which goes out in expenses. Say, for example, salaries, you look at rent, gas and electricity, other expenses which are incurred by the business. So these are things which are going out on a routine basis, but towards the end of the month or the beginning of the month, the company also receives a lot of money coming in. Now, in order
Right.
to
Yeah.
track the flow of this money, what you tend to do is you generate something called a cash flow statement.
Right.
And this statement, basically, when you, how do you prepare this statement? You prepare this statement on the basis of looking at, the changes which are happening because of income and expense. So what are the expenses which are happening on a daily, weekly basis, and what is the income coming in from the sale of good products or services on a daily, weekly, monthly basis. And then you look at these transactions, what you will tend to see is that you'll be able to create some sort of a statement which will be called a cash flow statement.
Cash statement. Yep.
Okay. Now the last bit. So after understanding, today the idea of this particular session is to understand the purpose of accounting, how and what kind of transactions or terminology we come across in the business when we look at accounting in general.
Right.
Okay. Now, last bit that we want to look at in terms of, is something called financial analysis.
Right.
You will tend to see that a lot of business owners, a lot of directors, a lot of managers in the business always look at some sort of analysis. That means how much has the business grown? What is the market share? Are we growing? Is the business increasing? Is our profitability increasing? So all these things that we keep track of in terms of comparison of, a performance of the company this year versus last year, or in a particular period, this period versus last Christmas period, is something which we will do and understand using something called financial analysis. Right? You look at your personal self. Sometimes you do your own analysis. You say, okay, 3 years back I was doing this job, I was earning this much. But now with 3 years of experience, I'm in a better job and I'm earning this much. So your financial position as, what do we say? Your financial position as?
Final.
Sorry, your financial position is? So if you're earning 18,000 pounds 3 years back and now you're earning, say, 26,000 pounds, your financial position is?
A lot more increased.
Is increased. So it is much better. So basically, analysis, what you would do is you would say that, okay, if you compare with yourself and you look at, the income that you're making with, say, for example, some of your friends, what you would do is you would compare that, okay, in my case, you will look at, say, for example, you'll say, in my case, for example, I've got 3 years of work experience now and I'm earning 26,000. I have a similar friend of mine who has 3 years of experience, but he's only earning 22,000. So what you're trying to do is you're trying to do a bit of analysis to see you are in a better position because of 1, 2, 3, 4 things. And that analysis that you do in terms of money, in terms of finances, is nothing but something called financial analysis. And all business owners would want to look at certain tools or techniques or ratios, as we call them, to try and analyze whether their position is better, or are they better off, or are they worse off as compared to some of the other competitors or businesses in the market. And what we tend to do is to analyze this particular business, to analyze the situation of our business. We at some point in time end up doing something called financial analysis.
Yes.
Okay, so these are basically a set of statements which we use to try and analyze, interpret, the position of a business at any given point in time.
Yeah.
Now, what are the objectives of financial analysis? There are two objectives. One, broadly speaking, two objectives. One is we want to look at the condition of the business at any given point in time. Are we better off as compared to the market? Is there a downturn in the market, and are we doing better? In recession, a lot of businesses, they basically looked at measuring their position vis-a-vis the position of their competitors in the market, right? And in some cases, you look at this analysis to basically judge the performance of the business. Is your business increasing year on year? Are you more profitable year on year? Are you, making more money year on year? And this can all be done using something called analysis, right?
Analysis.
And we have lots of financial analysis tools, and there are three different types that we look at. One is horizontal, the other is vertical, and the third one is ratio. So horizontal looks at, basically nothing but the trends in your performance over a period of time. What is the net change of income, say, year on year? So is your business turnover increased more, and how much is it more than over last year, right? So it is creating comparisons or doing comparative analysis vis-a-vis 1 year versus other year. Okay, so two time frames are being compared here, and that is nothing but horizontal analysis. Now, vertical analysis is when you look at events within a particular year, but over a point in time. So, for example, if we look at during the financial recession, we had the interest rate drop from 3-4%. It dropped down today to about 0.25%. So the expenses here for the businesses to borrow money are very minimal. So today money is available very cheaply to businesses if you want to borrow from the market. So because the interest rates are low, what tends to happen is that it also affects not just your business, but also makes the same thing available, easily accessible and available to other businesses or other competitors of your business, right?
Right.
When we look at events which are happening within a year rather than over a point in time. So if I have to look at something which is doing an analysis within this financial year, 2017-18, then I would do something called a vertical analysis. But if I have to look at this year's analysis vis-a-vis 2015 analysis or 2016 year, then I will do something called a horizontal analysis, because you're going across years. But here in vertical, you're looking at one financial year only.
Right.
Okay. And the last bit that we look at is something called ratio analysis. Now, ratio analysis, there are different types of ratios that we do in terms of business. So you look at profitability ratio, you look at, for example, liability ratio, you look at, payback ratio, you look at annualized rate of interest, ARR, as you would have heard. When you take out a loan, they calculate the rate of interest on the basis of something called ARR, right? So these are various ratios that we look at primarily to calculate the financial situation, or kind of to arrive at a financial situation for a particular business, using that corresponding ratio. And it could be, say, for example, what is your profitability? What is your gross margin? What is the ROIC, which is called return on capital investment? So, if I'm going to say put in £100 in the business, what is my expected rate of return? Sometimes you talk about that, if you when you look at people which tend to buy properties, as a means to, say, for example, investment. So what they look at is what is the return on investment. So you buy a property or a house and you kind of let it out or rent it out to someone. What they look at is, if I'm buying something worth 100,000, what is my rate of return in terms of the investment going to be? And in this case, what they look at is, if you buy a property at 100,000 and you're borrowing money at, say, 4% from the bank for the mortgage, and you get, say, £450 as rent, what they will look at is, using this return on capital investment, they will look at calculating the money which you will actually save if you are in positive. That means if you're going to make money on this property. That means a property worth £100,000 that you buy, you mortgage, you, say, for example, borrow 80,000 from the bank to mortgage that property, and at some stage you get a rental income of £400. What you will do is you will calculate how much interest you're paying on 80,000 to the bank for the mortgage, correct? And what is the interest? What is the rent that you're getting from the tenant? So assuming at 4%, if you have to pay a mortgage of 80,000 into 4%, you're roughly paying 3,200 as interest. And if I divide that by 12, what I'm looking at is that I'll be paying a mortgage of £266 every month to the bank. And if you're getting a rental income of £400, that means you're going to be in profit or making some sort of a net income of £133. So in a way, what you do is you calculate what is your return on capital. And this £133, if I divide by 3,200 in percentage, you're making 4% return on investment on your money that you borrowed. So these kind of analysis that we do, and explain that again, just to make sure that you're clear. The analysis that these kind of analysis that we do is to try and find out using the using the ratios to see if we can make money or if we are losing money.
Oh.
Right. So let's go back again to the same example of if you have some money available at your hand and you want to buy a property to buy to let, right? You're going to buy a flat and you're going to rent it out, correct? And you have to go, the value of the property is 100,000, okay? And you have to borrow 80,000 from the bank. The bank says we can lend you 80,000, but they'll be lending it to you at 4% rate of interest.
Right.
So if I have to calculate 4% rate of interest, how would I do that? 80,000 into 4% would mean that I'm just interest only mortgage. I'm paying 3,200 as interest for the year on a value of 80,000.
Right.
Correct?
Right, correct.
Now, if I have to calculate what am I paying monthly, so if you're paying 3,200 as a rate, as interest across the year, what this would be monthly if I divide that by 12.
12.
Correct? So I have to pay about £265 every month as interest to the bank to afford this mortgage. Correct?
Right, yeah.
At some stage, what you would do is you would also look at, okay, if I'm taking this risk and I'm going to buy to let and taking this loan out, can I also go to the property agent and find out what would be the approximate rental income that I would get from this flat? So you go to a property agent, and when you go to a property agent, you basically ask him, what is the rental income of this flat? So the rental, they say that the rental income is £400. Okay? And then you come back and you say, okay, I'm going to pay £266 as interest only mortgage to the bank, but I'm getting a return of 400 from the rental income. That means I'm still in profit. Correct? So what you will do is you will then go out and decide, and you say, okay, I'll go and buy the, I'll take, go and buy the flat and get your mortgage approved, and you'll basically buy the flat.
Yeah.
So what you've done in this process is you've used one of the ratios to calculate something called return on capital. Correct? Because if you're going to buy something at 100,000 and you're going to take out 80,000 as a loan from the bank for its mortgage, and you're putting in £20,000 as deposit, what you want to know is that are you going to make money on the investment that you're going to do, right?
Oh, yeah.
So if you're going to understand this, you have to calculate some sort of, you have to do some sort of a calculation to see that my 20,000, if I put in the bank and I get 4% rate of interest as of now, you know that savings as a saver, you only get 0.5% rate of interest at this moment. So if I keep 20,000 in the bank and if I calculate 0.05 or just say 0.05 rate of interest, which is a savings rate, 0.5%, that means I'm going to get £100 as savings interest on that for the year. And you divide that by 12, that means you're making about £8 roughly on that money which is lying in your bank. Right. So you decide that, okay, what I'll do is basically buy a flat, and against that flat, what I'm going to do is get a mortgage, because you have the money to be able to get the mortgage or raise a mortgage. So you go to the bank and you do your calculations. They say, okay, we'll give you, and finally you find out the rental income and you look at what is interest that you're paying, because you want to calculate what is the rate at which you will get money back. And that can be done using some sort of a analysis, right, isn't it?
Yeah.
And when you do these kind of analysis on your finances, these are termed under something called ratio analysis. Okay. But there are different types of ratios. So at this point, what we need to understand is there are different kinds of ratios that we look at, and there are 16 different types. There are formulas for all these ratios, and sometimes you use this in different situations to calculate what is the return on investment that you're going to get on the money that you have. Okay?
Yes.
So these kind of ratios is something which also we need to understand so that we clearly know what is the return sometimes you can make on the investment that you do.
Right. Yeah.
Right? So this kind of, looks at bringing us to the end of what we call, today's session, wherein we have at least a good understanding of the principles of accounting, the types of statements that we look at, why these statements are looked at, and at some stage, why do we want to know these statements so that we can make use of the financial information, and at some stage make the right decisions in the business when you're working in the business, or if you're the owner of the business. Okay.
Right. So yeah.
So two things which come out of today's learning outcome is that one, we need to understand what are the statements that we need to know. How do we interpret these statements so that we can take we can make effective decisions by knowing about them.
Right.
Yeah. Okay.
Yes.
Now, what I'm going to do is, apart from sending you this presentation, I'm going to also send you a bit of a handout for you to read. Now, we have only discussed the terms in general, and we've looked at the definitions, but what I'm going to do is, let's say, for example, for the ratios in particular, I'm going to send you a handout which has not just the ratios in terms of their definition, but also has their formulas.
Yeah, that'd be great.
Yeah. And then at some stage, what we will also look at is we will get interpreting, the statement. So if I send you a sample balance sheet or a sample profit and loss account, what you should be able to do is interpret that statement, a financial statement, to look at what are the assets, identify the liabilities, whether the business is making money or, is making profit at the end of the year. Those are the things that you need to be able to do when you look at these statements.
Right.
Okay. Brilliant. If you have any questions, then feel free to get back to me on email or phone. And what we will do is we will catch up, on the session same time next week.
All right.
Okay.
All right. Thank you very much, sir.
Okay. Thank you.